Welcome back to Palisade Radio. I'm your host, Tom Bodrovics, and joining me today is Kenneth Ameduri from Crush the Street. How are you today, Kenneth?
Hey, Tom. Thanks for having me on. I'm doing well.
Being as that you're a new guest on the program, could you give us a little background about yourself?
Oh, man, where do I start? Well, I've always been interested in money. My dad put it in me at an early age. He said, you know what, you're not going to get ahead in life by working for somebody. And he always put the fear of, having a really miserable job, I guess, from an early age. And, you'd always ask me questions about, well, what could we do to make our first $1 million? And, he'd planted these seeds in me. And I graduated into the 06, 07 Great Recession. And I was so pumped up about starting my first business, getting out there and buying some real estate and really capitalizing on the markets the way so many were around me. I was watching people make, so much money, $30,000 a month here, just stocks going up. And everything, just like we kind of saw, right? Last month, they all seemed to come to an end really quickly here. And unfortunately, I didn't get to experience that. I experienced the bust. Now, luckily, I didn't really lose money at the time because I wasn't really in the markets. But it's that whole moment where I watched all this happen with the desire for entrepreneurship that had me saving money and pursuing financial freedom for a very young age. And that's what led me to starting Crush the Street. That's what, first I became an investor, and then I started Crush the Street to really document my journey of being an investor, investing in sound money, gold, silver, other investments. That also led me down the road to cryptocurrency, making great money there, and covering the economy as it pertains to our money and our investments.
In doing a little bit of prep for this interview, I was reading through one of your articles on Crush the Street, and one of the quotes from it says, "I will not relish the pain that is on the horizon, but we will be prepared for a once-in-a-century opportunity that will present itself over the next 18 months." So considering, let's say, the first part of that, the pain on the horizon, where do you see that pain starting, and how are we going to look at that in the next, let's say, 12 months going forward?
Yeah, we saw the fastest turn from boom to bust that I think the world has ever seen. We've seen the world go into an economic grind and has been blamed on this coronavirus. And it's been described as the bubble that's been inevitably building up here, which I certainly agree with. And here we are. I mean, ADP just announced 20 million job losses, private sector job losses for the month of April. Massive, massive number. And again, here in the U.S., that's 160 million person workforce, and 20 million of those people filed for unemployment in the private sector, 30 million total since the start of this pandemic here. And it's just a monstrous number when you consider we've lost all the jobs since that '08 crisis, this whole boom that we've seen. We're now in the bust cycle of that. Now, what's interesting is that this is getting papered over at the moment. So the depressionary feelings, the experiences, the bankruptcies, really the bankruptcies, the defaults haven't largely started yet because trillions of dollars are being thrown at the system to sustain this. So I really feel like this is getting delayed. All of the true pain that's coming is not going to take place right at this moment. And the Fed is just doubling down. The government is doubling down on their efforts to combat this. And they're going to inject, trillions of dollars into the system. We're nearly at $25 trillion U.S. national debt. I mean, this is growing exponentially. I think at the '08 crisis, we were around $8 trillion. We might have a $5 trillion plus deficit this year alone. I mean, that's more than 50% or, around 50% of what the whole national debt was in 2008. Since the inception of the country, it took, over 200 years to get to 8 trillion, and we might do 4 or 5 trillion in just 1 year in response. And again, it's this Fed doubling down crisis after crisis to combat this. And ultimately, it's a dollar failure because finite resources like gold and silver and things like real estate and even certain stocks, they're going to be considered safe havens against the depreciating dollar. And that's what I see happening going forward here. I see a lot of volatility in the markets as bad news continues to trickle in. We really haven't seen a lot of movement in real estate yet. I believe that's coming. We haven't seen a whole lot of movement in stocks yet. I think we're going to see a lot of volatility in stocks. But to that degree, we know that the Federal Reserve is going to do everything they can to throw trillions of dollars at the system. Because of that, you have to consider the caveat that stocks will, to a certain degree, act as a safe haven against the devaluing dollar. And I know a lot of people want me to say, hey, stocks are going to 5,000, Dow Jones 10,000. And while it's possible, you have to price in the fact that the Fed and the U.S. government and governments around the world are going to throw everything they can at this. And, you have to consider that they might paper over this before we see an ultimate just flushing of the system, which ultimately is something like hyperinflation. So, it's nuanced. We know that there's going to be a lot of pain. This V-shaped recovery everyone is talking about is a fantasy. It's not going to be a V-shaped recovery. It's going to take time. It's going to be a lot of flushing out of defaults and problems throughout the system. And when we see that, opportunities will arise. And, we're in the middle of that opportunity now.
So that article that I pulled that from was called The Deepening Crisis, Gold and Cash Are King. So in your view, are we able to contrast gold and cash going forward once that inflation starts to hit as negatively correlated versus right now, cash is good to have to be able to invest and gold is also great to have considering it's a store of value?
Yeah, it's an interesting dynamic right now. On paper, fundamentally, the dollar is a horrible investment. Owning U.S. dollars, it makes no sense at all. But the reason why we are seeing the dollar as strong as it is because the whole world is acting in unison. We're seeing the failures of Europe and what's happening there. We're seeing China, this whole coronavirus pandemic, they're not going to recover from global optics and sentiment for many, many years to come. So, investing in China is going to be on pause for a while now. And to that end, the U.S. dollar is going to be somewhat of a safe haven, even though it's going to be trashed by the money supply continuing to expand. So cash and gold in this environment, cash, U.S. dollar cash is going to be great for liquidity and taking advantage of opportunities. And gold is a form of cash. It's liquid. And it'll be a hedge against that devaluing currency, which I see happening. And by the way, my prediction is that we are going to see the mother of all infrastructure plans rolled out here in very short order to put many of these people back to work. It's going to be a huge infrastructure plan to get the country rebuilt. And they're going to do it on the backs of taxpayers and debt, which is going up exponentially. I mean, it's a Ponzi scheme. And when you really consider what is happening, let's say they are able to paper over the problems that we're having right now. What's the next crisis going to look like? Ask yourself that question. In 5 to 10 years, what are they going to be trying to do? Are we really going to be able to raise interest rates over the next few years? I don't think so. There's nowhere for them to go. There's no way to pay for these interest rates or higher interest rates. And the extremes that the Fed and central banks around the world are going to have to go to is beyond our comprehension in so many ways. The Fed's right now purchasing junk bonds. I mean, that's the lowest end of the totem pole that they've sunk to. And here we are. So the fact that they're going to these extremes to be able to do this, to paper over this crisis, you have to take that into account when you are looking at investments. The stock market does not equal the economy. And that's the biggest point that I want to make here. You can't look at PE ratios. You can't look at fundamentals to try to decipher what a certain company is going to be worth when you have so much manipulation going on in the system. And one thing I'll point out is basically since 1959, the M2 money supply started out at 250 billion. I mean, just a fraction of the overnight repo market number, but that was the entire M2 money supply. Today, that number is $16 trillion. And annualized, that's 52 times, which comes out to about 6.7% annually. Just to correlate that to stocks and real estate, that's eerily what stocks and real estate do year after year. It basically tracks the growing money supply. And with what the Fed and what the governments are talking about, throwing trillions of dollars at the system, you have to assume that it's going to fall into the hands of stocks and real estate going forward here. So I do believe that there's going to be a lot of volatility. I do believe stocks are going to see some lower lows here, bound for it. But because of the response we're going to get from the Fed, I think we will see them rebound over time. And it will partially be a hedge against inflation. But I got to be honest, I like gold and silver a lot more for those reasons.
So as we're talking of gold and silver, why, in your opinion, is silver not going up with gold right now? Why is it lagging?
Well, it's got that industrial component, unfortunately, and there's obviously a lot of manipulation. It's a smaller market. And, JP Morgan, a lot of smart people talk about the problems that silver has on that front. But when you look at what's going on the physical side, it's difficult to get a silver eagle for, under $25. The spot price is sure $15, but on the physical side, it's much higher than that. And, it's very difficult to get gold and silver right now. A lot of delays. If you've tried to buy gold largely over 1900, 1850, if you actually wanted to get an ounce delivered to your house. So this is really what's going on in the physical gold market. And it's been a great hedge against this crisis. Back in 2018, when the government started to raise interest rates, attempting to raise interest rates, we saw stocks fall by 20%. And that's when we started to see gold and silver start to get some traction. And that was the real sea change that took place. Last year, we saw problems in the repo market. And then this year, we really saw gold start to take off. I think silver is going to follow. It's going to be as the chips settle. It's like they say, gold goes first, silver goes further. And so I believe that's going to happen. I believe that historical precedence of the gold-silver ratio going to converge. I believe that's going to happen. And, I like to invest with inevitabilities. A lot of people have these, exact numbers that they look for. They expect the stock market to fall to a certain number or gold to go to a certain number on a certain date. I just don't believe in that. I believe in positioning yourself in what is inevitable, what is likely, what is probable, and having that diversified approach and looking at the facts. A lot of people don't want to talk about the things that we're talking about right now, but we're having a real conversation and facing the cold, hard facts of the problems that are facing our economy. And by doing that, it'll give you the best opportunity to position yourself ahead of the game.
When we're thinking about positioning ourselves, are you mostly focused on physical gold and silver or miners or even the royalty plays?
I focus on gold miners, producing companies, and also exploration plays. I also own physical. I like the physical, and I recommend people look at both. If you're looking for the leverage exposure to gold and silver after you've established your position, you need to look at the miners. This is a place where you've historically seen outpaced returns. And, seeing the GDX go over that 31, 32 level here, we're getting a lot of confirmation that the miners are moving. There's confirmation from the big money. In fact, Newmont has been one of the best trading companies on the S&P 500 for the year. It's a huge play, a huge opportunity that we're seeing, during this volatile time. So yeah, the miners, I don't look a lot at the royalty plays, but I like physical. I like the miners.
Are there any key things that you look for in miners?
Absolutely. It comes down to management. It comes down to the people running the company, because these are the ones that are going to be able to get the financing that they need. They're the ones that are going to be able to find the projects, network, identify key assets, be in the right jurisdictions. I mean, look right now around the world, certain countries are shutting down while others have mining as an essential business. Jurisdiction certainly matters in this environment. So yeah, it really comes down to the people. I really like focusing on people that have success, because once you've achieved a certain amount of success, additional success in the form of momentum is attracted to those kind of people, and they're able to push things through, while other people, it's like starting a new business. But with people who've done it for many, many years, those are the people you want to attach yourselves to.
Makes sense. As we've seen oil prices go negative, that only makes things better for the miners. But what do you see for oil prices going forward?
Well, looking at the economy, oil is one of the only things that are somewhat trading at the free market. Despite certain types of manipulation, oil is reflecting the oversupply that we are seeing. And oil did something that I think a lot of people were blown away by. I didn't even think that oil could go negative or would go negative, but here we are. We saw that happen. It was an implosion of the market, a breakdown in the market. And we had it happen. And I think that shows the true underlying vulnerabilities that are happening in the economy. And because of that, because of what we saw there, I think something similar to the upside in gold and silver could happen. A breakdown in the futures price where, these unallocated, rehypothecated prices of gold and silver break down on the futures market, and we see a massive run in the price of gold and silver as it breaks down, as people want delivery, as they want it in their hand. They don't want a cash settlement. They want the real physical. And the more things break down fundamentally, the more people and investors will panic. They're not going to trust the system. And so I think seeing that happen, seeing that as mainstream headlines, was a massive wake-up call to people around the world that the markets are very vulnerable. We're talking about things right now and seeing things on the mainstream media that nobody thought could ever happen, would ever happen, but here we are. And this is not conspiracy. This is real failures on a global scale. And so I think oil is going to suffer for many years. And unfortunately, I live in Texas. Oil is a massive part of this economy. $40 oil was okay for these shale producers. But once it got into the $30 range, and here we are in the $20 range, this is going to be very, very difficult for much of what was good jobs that were created during this, from the '08 crisis until now, a complete implosion of that industry, unfortunately. And, I don't see people going on airplanes to a large degree. People are hesitating going to ball games and sports arenas. The people are not ready to go back. They're not ready to book cruise ships and so many things that would require us to go back to see this V-shaped recovery and for oil to go back to where it was. So I think oil is going to be under a lot of pressure here for the short to midterm for quite a while, to be honest, because I don't see this turning around anytime soon.
Kenneth, as I know you really like Bitcoin, could you share with us your thoughts on the upcoming halving and Bitcoin being a store of value?
Absolutely. Well, there's only going to be 21 million Bitcoins ever created. And, the longer Bitcoin continues to be around, the longer it proves itself to people. We're back over $9,000. It did sell off during the crash. It seemed to move almost with the S&P 500, and that was a lot of people were criticizing for it. And so did gold to a certain degree. In the liquidation moments, there was a lot of margin calls and many things that caused just a sell-off in everything. But gold quickly recovered from that. And we are now back. Same thing with Bitcoin. Bitcoin has completely recovered from where it was prior to this sell-off. So it's one of those things. It's limited. And as the governments continue to get out of control, people are going to look for freedom in their money. And when governments continue to push people towards cashless societies, Bitcoin is going to be there. And, again, I know it's controversial. A lot of people feel like the Bitcoin community is like a cult, but, I'll let the results speak for themselves. I mean, look to see where Bitcoin is in, 18 months to 2 years, 3-4 years out. I personally think we could see $50,000 Bitcoin here. I don't think that's out of the question. It's an early stage opportunity. And, the longer it's around, the more viability it continues to prove itself. It's only been around for 10 years. Gold and silver have been around for 5,000 years. And in that 5,000 years, it's been able to, acquire some sort of equilibrium, even though I believe they're greatly undervalued right now. Bitcoin has only been around for 10 years for the world to discover what its true price should be. So having said that, this halving will be, a quantitative hardening of money. There's going to be less Bitcoins mined every 10 minutes. And when you're talking about a world, endless money printing, QE to infinity, you want to own things that are finite. I think Bitcoin is a great place to store some of your money.
In your opinion, is Ethereum almost like the silver to gold as Ethereum to Bitcoin?
I tend to believe that Ethereum will do well. There's a lot of applications that can be done on Ethereum, a lot of growth, a lot of smart people that are contributing to that network. And that's what you're investing in. You're investing in human capital. And Ethereum does have that silver to gold sort of move. And I believe Ethereum will actually outpace Bitcoin in the next move that Bitcoin has. But again, it's going to be on the more speculative side of things in terms of what it is. It's a little more centralized, and there's more Ethereum that are out there. So you're trusting people a little more when you invest in Ethereum as opposed to Bitcoin, which is truly decentralized. No one controls it. And so I do believe that it will, just like silver, Bitcoin will go first, Ethereum will go further. I think that is going to happen. But I'll caveat that with this. That was Litecoin's role a few years ago. And Litecoin has basically become worthless to so many people because it was essentially just Bitcoin 2.0, but it didn't have a different role other than money. And now when Bitcoin moves up, Litecoin doesn't even keep up with it. So, that's what a lot of people thought about Litecoin, and it's not even keeping on par with Bitcoin anymore. So I would say if people don't own any Bitcoin, start there before they go into Ethereum.
Any concluding thoughts as we wrap up here, Kenneth?
I really want people to understand that in this environment, people need to be resilient. In my article today that you were referencing, cash will be king. Prior to this, people were chasing yield, chasing growth, chasing, cash flow, all of these different things. And in a moment's time, we saw all of that contract and basically turn on a dime, evaporate. The stock market falling through the floor, unemployment skyrocketing. Things can change rather quickly. And it's in times like this where your resilience, your financial stability is going to truly show itself. So really value just wealth preservation, not just always yield and growth, but truly value wealth preservation, purchasing power reservation, and don't act hastily in this environment. This is the time to really hone in on having ammo to deploy and being able to take advantage of opportunities. I think the mining sector right now, we're in an early stage. We're in the first and second inning of a truly spectacular bull market that's coming. And so being able to deploy capital here is, in this time, could be, a once in a generation opportunity. Considering where gold is right now and where the miners are, there's truly an asymmetric opportunity there to be had. So yeah, I mean, if people want to visit my work, I'm at crushthestreet.com. Do regular posts there, and we got a lot of reports that people can sign up for right on the homepage. And I do regular interviews at my YouTube channel at youtube.com/crushthestreet.
Excellent. And if our listeners have any questions or comments about today's show, please email me at tom@palisaderadio.com. Kenneth, thanks very much for your time today.
Thank you, sir.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?